Jeff, hello. Please grab one of the comfortable chairs. No, take whichever one you like, John. Mike, welcome. So come and settle into the comfortable leather chairs. Now, when you sit back in these chairs, it's conducive to big thoughts. This is, you have to imagine we're in the library here thinking discursively.
That'll be a new experience.
So, thank you all for joining us. Mike Volpe from Index, Jeff Young from Redpoint, John Lilly from Greylock. I didn't realize we had this duplication of Greylock, but I suppose Anil is a little distance from Greylock now, so
that's what he says.
Not too much overlap here. So let's just dive straight in with this. I think the question that we in the media were kicking around for a lot of the year, but we seem to have forgotten in the last couple of months, which is, is there a bubble? What's happened to valuations? And it felt like it was the only thing we were talking about for much of the year. August, the markets sort of got a bit bumpy. We've had some very interesting IPOs that have gone up and down, and who knows where Zynga's going to end up. So let's take stock. How should we think about it, Mike? Did you think this is very bubbly? Do you think it's bubbly? You've just come to the Valley, right? You've just moved here this summer, so you...
Yeah. I wouldn't define it as bubbly or bubble or anything like that. I think that there's two dynamics that are happening right now. One is that, and Jeff, who's been doing this work for a lot longer than John or I, will probably attest to this, but over the last 20 years, more and more of the power of the balance in a negotiation between, say, a venture capitalist or an investor and the entrepreneur has been shifting towards the entrepreneur. Entrepreneurs are getting smarter, more knowledgeable, more experienced, and with that, they can keep more of the value of the company.
So they're not a soft touch anymore.
Yeah, I mean, there's less information asymmetry between investors and entrepreneurs. So there's generally a trajectory of valuations in private stages and in public stages kind of going up overall. The other trend is that there's a lot of interesting new things happening right now. If you look at the business models that you just talked about, whether it's Groupon or Zynga or LinkedIn, these are very new business models. They're selling different kinds of products. They're selling them with social effects, which we haven't seen before. And when you enter that type of a phase where new things are coming in the horizon, investors candidly have a very difficult time, both professional investors and everyday investors have a difficult time assessing exactly what the long-term value of those new business models are. And so they, in good times, like we are relatively speaking now in the Valley, they give the entrepreneurs the benefit of the doubt. They say, well, I'm just going, until you prove me wrong, I'm going to assume that you're right about what your business is going to turn into. And if the entrepreneurs can execute on it, those companies will then grow into their valuation, the way, say, a Google has. If the entrepreneurs are wrong, eventually those valuations will come down to a lower level. And I think that that's, generally speaking, those two phenomena of entrepreneurs gaining more strength and investor giving entrepreneurs the benefit of the doubt are what's creating healthy valuations, especially for companies that are more promising.
So Jeff, Mike I think he paid you a compliment there. He suggested you were the greybeard on the panel here. You've been through this a few times, these cycles. Does this feel like any cycle you've seen before? And
I don't know. Since I'm only 28, it's no. I think the question of bubbles really can only be answered in hindsight. And a bubble, the connotation of bubble is something that's about to burst, you can't really answer it kind of when you're in it. But I will say a couple things. The first is that I think one of the most exciting things about the investing in the businesses in which we invest right now is that we're in a completely new world. When I got in the venture business 26 years ago, we were really investing in small cottage businesses. I mean, we were investing in companies that would, mainly IT back office, type stuff. We were going after small markets. They were pretty much all enterprise. And when you think about the markets that we're going after right now, the market, technology has gotten extremely mainstream, and it's part of, almost everybody's everyday life, and it's global, right? And when we used to look at markets, they were really just U.S. markets, and rest of world was kind of an afterthought. And today, you think about these markets globally kind of from day one. So the expansion of the size of market has gone from a cottage industry to the very mainstream. And so we're looking at market opportunities that are, I would say, several orders of magnitude greater than what we used to look at. And so all traditional metrics for valuation as a result are kind of out the window, and it's kind of, and we're all trying to figure out what is the right new metric, for companies that are growing faster than any other company that's ever been able to grow in history, and size of markets that the technology business has never seen. And so, on the one hand, you say we're in a completely new world. The other side of it is, I think, on a relative basis, and you and I were talking about this a little bit, and you said it in your introduction, I think the technology business is one of the most interesting places to be, over the next 10 years. I think growth is going to be, globally, is going to be very hard to find. And growth without sovereign risk, i.e. kind of emerging market, kind of risk, you're going to find, I think, a lot of investors flocking to a lot of these companies in which we invest that are much more stable, that have growth, and they have profitable growth. And so I think you're going to see valuations that are at a premium, generally. And whether we're in a bubble or not is very hard to say. I will say that I think it's been effervescent, and that I think you go through these times when valuations go up and they go down on a relative basis. But over the long term, I'm very optimistic for the industries in which we invest for the next 5 or 10 years.
Now, what are the metrics that you like the look of when you say you have to develop new metrics for these new markets? And anything particularly you follow, you like to look at when you're looking at?
Well, no, I mean, I think you look at growth rate, and you look at EBITDA multiple, and I think by some of those metrics, some of the most exciting larger companies that are out there in the market aren't significantly overvalued. Whether you look at a Google or you look at an Apple, relative to its growth rate and its ability to generate profits. And the reason that some of these private companies are valued so high is because they're growing at growth rates that have never been seen before, and they have profit models that are really very interesting. I mean, the things that can be 40% EBITDA, kind of margins. I mean, it's pretty good business.
Yeah. John, what do you think?
Well, look, so I'm the new guy in ventures. So I've been here, I've been doing at Greylock for a year, about 20 years as a technologist and an operator. And so, my point of view is new. I think it's been an interesting time to learn the venture business. I think we'd be lying if I said I didn't think that some of the valuations paid were crazy. Like, I think there's certainly a speed to financing and evaluations of financing, which I think in retrospect will look very high on some companies. But I think there's a few companies that that feel extremely high priced now that will seem cheap in retrospect. I think there's a couple reasons I think that. The first is that the leverage that technology brings is amazing. You think about Anil starting Workday compared to PeopleSoft with so many fewer people. You think about Facebook's got 3,000 people compared to Google's 30,000. You'll talk to Drew later from Dropbox. Everybody in the world uses Dropbox, and they've got like 80 people on staff. Tumblr, where I invested, serves about 13 billion blogs 13 billion page views a month, when they got 50 people, and that's only because they started hiring lately when we did the bigger round. So the leverage, I think, is incredible and unprecedented and global in scale. The second thing is that from a technology point of view, it feels like we're reinventing the whole world. Like the way we interact with each other, with companies, with how we learn, how we get healthcare, everything is changing because of mobile, because of social, because of the cloud. And so I think that these waves are humongous. They'll be huge. And I think they're going to look small in retrospect, because I think pictures under glass, this interface, is clearly a transitional technology as we start to interact with more things in our environment. So I think things are overvalued, but some things will be transformative and undervalued in retrospect.
When you talk about Tumblr, you bring up just the page views and incredible growth. Is eyeballs a metric now that's back in fashion? It just seems that some of these consumer internet companies get such incredible leverage, and it's taking off before the revenues, before the EBITDA.
Yeah. So
how do you value that?
Yeah. So we invested in Tumblr in August, and the question of eyeballs never came up. What you're always trying to do is trying to look for a proxy for how important is this interaction to people. And when you talk to Tumblr, what's obvious is that the engagement with the content is just off the scale high. That people love Tumblr.
But isn't engagement just another word for eyeballs?
No, I don't think so. So I mean, eyeballs is a little bit of a passive metric. Engagement is how often do you interact with the content, how often do you amplify it, how often do you share it, and that's clearly happening. So the average post on Tumblr gets shared 9 times on other people's Tumblr logs, and so there's an interaction with the content that's clearly valuable to fashion, sports, political, virtually everyone. And so for us, it looks like there will be something. We love Facebook, obviously. We're a significant investor in Facebook. We think there will be something after Facebook. Right now, Tumblr looks like that to us.
Really?
I think it's important also when you talk about this issue of eyeballs, there is a very big difference today versus 10 years ago, which is that 10 years ago, when you said eyeballs, basically the only way you could monetize it was to slap a display ad on there. And display ads were pretty simple CPM business models. So it's just basically an ugly ad that sits on top of the page. I think today you see a whole lot of more interesting ways of monetizing it. There's freemium business models, there's promoted content, there's search, AdWords, AdSense, et cetera, et cetera. So I think that I think it's always risky to think of eyeballs as the metric. But I do think that the industry has evolved to the point where the methodologies of monetizing eyeballs have become significantly more sophisticated over the last decade.
But there are, for a consumer company, there are really three ways of creating value, right? One, the most easiest and the fundamental value is that you drive revenue, you drive earnings, right? And that gives you long-term value, and you can take that company public and that kind of thing. The second is to get a really engaged audience, and it's more than just, what John was just saying, it's more than just eyeballs, it's an engagement of a targeted audience that maybe somebody will want to pick up because they're trying to expand their reach and they've got a monetization network that can engage that audience. And then the third is if you develop some core technology that somebody might be able to exploit in a different way. So for instance, targeting technology, it might be more valuable to an acquisition for someone who has a lot of inventory, can use that to monetize their inventory than it might have as an independent, company.
Well, you talked about, you don't just slap a display advert on these things. Is social advertising a proven concept now? Obviously, we're all waiting to see Facebook. We're assuming it's going to go public next year. Tumblr is experimenting with these things. Can we assume that it's a given that the Twitters, the Tumblrs, and the Facebooks have really discovered an advertising model that works for social?
I was just going to say that I think what has shown value gets created. You first create a lot of inventory, and then you figure a way to turn the inventory into something valuable. And in each of those, you can look at valuations. I think I've gone back and I looked at valuations of internet companies, and it goes to this period where traffic goes up. The valuations go up, then they start coming down, and people figure a way to monetize that traffic, and the value goes up again, and it goes through these cycles. So we're now at this stage. So the targeting technology, for inventory, basically spinning straw into gold, turns out to be a really important part of that cycle. And first you had in the first wave of the internet, you just slapped kind of banners on and completely untargeted ads. And then people figure a way to do more demographic targeting. Then they figure a way to do demographic and location. And recently you've had more behavioral targeting on commercial, on commerce type of transaction, where you look at what people have done in the past, and you figure a way to get more targeted advertising to those people who are in market to try to do a commerce transaction. I think with social, one big question has been, how do I retarget the inventory so that it's not just a blind, kind of banner ad? And I think it all depends on, there are all sorts of neat technologies to increase the targeting, of social. One way I think that's going to really evolve is kind of interest-based targeting. Trying to figure out based on who you know and what you read about, what your interests are, and figure a way to turn that inventory into something more valuable.
Has this not been cracked yet? Has anybody solved this problem?
I don't think it's been cracked yet. Right now, you have contextual targeting, that where you just read what's on the page and you figure out, what you're going to serve them. Over time, you're going to figure out what people's interests are and then figure a way to target it.
I think, as Jeff's saying, it's evolving from just a piece of real estate that people are slapping something on it to contextually relevant, meaning if you're looking at that web page, in all likelihood you should want to see an ad that's relevant to that web page. To then it's becoming behavioral, so you kind of know who I am and where I've been, and based on that you give me some ads. And then the final stage of it is, as Jeff was saying, is that you figure out what I'm actually interested in based on what I've done as well as who my friends are, and get an increase again in terms of the targeting capabilities. And each step of the way you create more yield and you follow the action. So monetizability of display ads has grown by leaps and bounds. Some of these retargeting technologies, for example, will get 12 to 15 times the click-through rate of a regular display ad. So it's pretty spectacular in terms of what this ad technology has done.
So, let's go back to this question of valuation. So, you said that a handful of very big companies are coming out of this, and some of the traction these consumer internet companies are getting is tremendous. Obviously, we learnt after the last bubble that very few very big companies emerged out of that. And what had happened was a lot of second-tier companies had attracted high valuations on the coattails of the winners. Is that not what we're seeing this time around? Obviously you can't tell which the winners are going to be, but it does seem that there's a pretty large pool of billion-dollar valuation private companies out there.
Well, I think you can't tell until you see it in the rearview mirror, honestly. I think it's very, very hard to tell proactively. Obviously, there'll be, I think there'll be some that have just fundamentally transformed the world. I do think the addressable market's much, much bigger than it was 10 years ago. Just significant, like an order of magnitude bigger. I think that we all have multiple devices now. You can get to almost anyone in the world from wherever you happen to start. So I think it's very hard to tell, except retrospectively.
So there will be more, there won't just be one or two very big social players, there'll be 5 or 6?
I think it's risky to kind of conclude that all interesting consumer stuff is just social. There's a lot of variants that are out there, and I think that there's a lot of categories that are being reinvented. Everything from Dropbox, which is sort of shared storage and file sharing, to obviously Facebook, to social games. There's a lot of different categories. And it's arguable, but a fairly robust argument to say that in each one of those categories there might be one or two winners. And they're pretty different and broad-ranging categories. And the point I think these guys are making is that there isn't one category, there's 5 or 10. Now, are there companies out there that are getting values that don't deserve it? Absolutely. But that's the story of this business. You just, a priori, you don't know. So you have a portfolio, and then eventually you have a couple of winners and a couple of losers.
All right.
Yeah, I want to just highlight, people talk about social as a category. I just think it's not that. It's kind of like, the insight from social is that people like doing things with other people. And you like doing things with other people no matter what industry you're in. And there's across all industries. You eat dinner, you play sports, you go out to eat, you do lots of things with people. So I think social, clearly there's business and there's education and there's play and all sorts of things across social. It's not just kind of...
just on that, I think the internet is social and mobile, period. And I don't think we see, I certainly don't see any company coming in with a new idea that doesn't have social and mobile integrated in what they do. So this concept that we only do mobile deals or we only do social deals is kind of a fallacy. If you're involved in anything related to the internet, it's all about mobile and it's all about social. But going back to the valuations thing, I think if you go through time, you can never overpay for the great companies. The problem is you don't know a priori who the great companies are. And what ends up happening when valuations rise is that it rises all ships, and the third and fourth and fifth and sixth companies start getting these valuations that presume that they're going to be one of the winners, and they aren't. And in any one space, you're only going to get 1 or 2 winners, not 5 or 6 or 7 or 8 winners. And what happens is when cycles come, the good ones always prove out to be great investments, and the ones that were the also-rans turn out to be just horrible investments. And what you see, I think, is that when there are downturns in valuations, the good companies don't really suffer the same downturns, but the bad companies kind of fall off a cliff. And I think where we are right now is we're in a segment of the market where in the past 6 months everybody's been rising, and that just isn't sustainable. And I think with the more recent volatility, we're starting to see a little bit of break in the valuations where, you know, the cream will always rise to the top. And even in, you know, 2009, you saw valuations of the best companies not really breaking, but everybody else just collapsing.
So we are in a different phase now to earlier in the year. Has it broken for the second tier companies? I mean, they still seem to be getting pretty good values out there.
Well, I think our point of view on the consumer internet in particular is that it's winner take almost everything. So the breakout winner in a category will almost always win the lion's share. Now, and then you have to figure out, number one, defining a category is actually a little tricky because category boundaries are a little blurry. And then trying to figure out whether the category itself will be the durable, important category is important too. But, you know, we tend to obsess about two things, both in our consumer and our enterprise business, which is all we do at Greylock. We tend to think about is there really high like product quality and product centered? Is it a really great experience? Because on the internet, everything is just a click away. Like you can, if you don't like it, you can use something else. The second thing is we talk about durable distribution advantage. On the consumer internet, that tends to be network effects. So the reason LinkedIn is going to be a durable business for a really long time is they built a really robust, durable network. And, you know, being outside of LinkedIn is not as valuable as being inside LinkedIn. So we look for businesses that look like that that can get there quickly because of network effects.
In a minute, I'm going to ask you for one example of an area you think you really want to invest in, and an example of an area you think is really overvalued. But I'll give you notice on that one. In the meantime, what lessons haven't been learnt from the last bubble? Do you see symptoms of anything that happened last time around in the way companies are behaving, the way they're being financed, the types of companies?
You know, I think that the last time you saw a lot of companies going public purely on expectations as opposed to grounded metrics. This time around, I think, you know, you can argue, is profitability really totally there the way you want it to be? But it's pretty hard to go public without some pretty credible metrics right now. I mean, you know, if you take Zynga, for example, right? It's a big, profitable, and reasonably fast-growing business. And there's no question about it. It's not going away overnight. That's a robust, LinkedIn is a robust business. These are real businesses. And I think that the last bubble you saw IPOs that were just like, we got a lot of eyeballs.
But this time we've seen Groupon, which, depending on how you measure it, either is or isn't a very profitable business.
I think that's probably, I would argue that that's not representative. I think Groupon is in a category of its own. And a lot of it hasn't played out enough to really know what the profitability is for Groupon long term.
You're in Groupon, right?
No.
No. All right. Anybody in Groupon?
We're in Groupon.
Groupon down there. All right. So did you want to be in Groupon?
No.
So you are in the not convinced camp long term?
I am not, in that particular instance, I'm not convinced that there's profitability long term.
Why not? It's growing tremendously. If you just take out the marketing costs as they suggest you should, then that's a tremendously profitable business already.
I think the company hasn't been through enough cycles to understand the retention they get from their merchants.
Care to respond, John?
We feel okay about it. We think Andrew's a really good chief executive. We feel like he's built an executive team around him that it's built for the long haul. So we feel like they'll be all right for a long time.
One thing in the last bubble, you know, people got criticized for flipping companies. You know, the idea was you'd build up some value quickly and move on, and it doesn't seem to be happening in quite the same way this time. But instead, what you're seeing is a lot of individuals maybe flipping their careers. It seems that, you know, people are waiting for a valuation to get to a nice level and then moving on, taking the next stock deal from the next company. Is that a concern? Is it a bubbly mentality?
Yeah, I think there's a lot of mercenary behavior going on by entrepreneurs, and it's bound to happen. You know, when it's kind of human nature. You know, I think that happens. But you see it in, you know, you used to never provide any liquidity for founders until, you know, there was an IPO or a sale. And now you're seeing it very commonplace that founders take out liquidity, you know, early on before the company, you know, sees any success, and in some cases take out, you know, substantial liquidity. I looked at a deal last year where some founders took out substantial amounts of money on the first round, you know, from the seed to the first round, and, you know, some reputable firms did that, and I just think it's just it's very bad, behavior. And so, I'm seeing entrepreneurs coming in, and they're only talking about wanting to make money instead of wanting to build something great. And all the great entrepreneurs that I think, we've all been with or seen, they're in it because they want to change the world, and they want to see a vision that they have, come to reality, and they want to change the world. And the best entrepreneurs aren't in it to make money. Making money is kind of a byproduct of creating a great company. And so I think it's very dangerous. And the other thing I'll say is I see a lot of entrepreneurs raising lots of money, and you would have thought that we would have learned more from the last cycle. An excess of money in the bank creates sloppy behavior in execution. And I think a lot of the entrepreneurs have forgotten that or weren't part of that. And when you raise lots of money, you end up not making the difficult choices, you end up not focusing, you end up not delivering, working on delivering customer value very quickly, and you end up getting sloppy, and I think it builds inferior companies.
On the flip side, I think that we have enough role models, enough examples now of founders who started companies, flipped them, and then got disaffected and bounced out of Google or Facebook or wherever they went to. And we're lucky at Greylock because we have Anil and Reed, both who have, Anil started Workday, Reed started LinkedIn, who both want to be with, associate with those companies for their whole careers. And I think it's a pretty powerful message when an entrepreneur comes in and sees those guys, and those guys say, well, look, like getting something special that works like this, it doesn't happen very much. And so being in a place like this gives you tremendous leverage. And so, we kind of know it when we see it. So you see a guy like Drew Houston come from Dropbox, and you talk to him, and he's like, I want to run this company for the rest of my life. And so I think a lot of entrepreneurs haven't learned it because easy money's out there, but I think a lot can see examples.
I had a conversation with Chad Hurley a month before he sold to Google, and he told me just that. But
sorry, who?
Chad Hurley, YouTube. I mean, it's everyone wants to build a company for the rest of their lives until.
Yeah, I don't know. Well, that's the trick, isn't it? That's the trick as an investor. You make a call on whether you believe it or not. I believe Drew.
Yeah.
In fairness, I think how one responds to a question posed by a journalist and how one really feels are not always the same.
Tell us how you really feel.
But I have to echo what they're saying, which is, look, it's human nature, right? So in every era, I haven't been a venture capitalist for that long, but I bought a lot of companies at one point in my life for my employer. And, you have entrepreneurs who are in it for the money. They generally don't build the biggest, most interesting companies. And you have people that are in it to build great companies, and they generally do. So you're going to have a spectrum of people at every cycle, every phase in the cycle. And now is no different than 10 years ago.
But it's more so now than it has been for 10 years. Is that fair to say?
No, I think there's opportunity for people to make more money now than there was, say, 5 years ago. But I think the desire for people to take money off the table and that spectrum of people that you find in the entrepreneurial business has been there and will always be there.
Yeah. In terms of just the sheer amount of cash that some of these companies are raising, Jeff, you raised it. A lot of their VC investors are telling them to take the money now because now's the time. The window's open, the money can be raised at good valuations. So you'd be stupid not to, get an insurance policy for the next 5 years. Isn't that what you're telling your companies?
That makes the most logical sense. It's hard to, because the other side of it is no company ever went out of business because they had too much money in the bank, right? And you go through all these kind of common points of view, and logic kind of comes in. And the entrepreneurs will always say, well, we won't spend it. We'll just leave it there as kind of an insurance policy. And I'm just telling you, my experience is it doesn't work. My experience is when the money is in the bank and they don't fire the people that they should fire. They don't make the trade-offs on which project they should work on and which one to bet the company on. They work on both projects. They don't, necessity is the mother of invention. And I think it just, my experience is that companies work better when there are tough trade-offs that have to be made and it's lean. And I know that every piece of logic says you should raise the money when you should have it, and you don't have to think, you can pretend like it's not there. but it just doesn't happen. You know, the employees don't think that way when they're thinking about, well, you know, we have to make the trade-off. They always think, well, what is the money there for if it isn't to invest in what we do? They always push out, you know, profitability. That, you know, it's a whole range of things, and I can't really explain why you can't change human behavior to think as an insurance policy, but my experience is that people just don't think that way. And so I'm always in these discussions trying to limit the size of the rounds to more reasonable amounts.
So what about the areas that you think are overvalued and you're staying well clear of, and the things that you think look very attractive right now? John, what about you?
Sure. The ones I'm most excited about are, I think that the way we interact with I'll give you two that I'm most excited about. I think the way we learn, the way we interact with education is about to be completely transformed at every level, from being a kid to being an adult. I also think the way we interact with our personal healthcare, I think healthcare is about to get consumerized, and we're gonna know more and more and personalized. So I'm excited about both those areas, especially as they relate to consumerization of technology. The one that I have a hard time getting excited about, I think is overvalued, is the glut of services that are around that are targeting SMBs, small and medium-sized businesses. I think the technology waves tend to start either in consumer or enterprise. They tend to move to consumer enterprise, the other one next. And I think that people tend to look around for places that haven't been touched after that. And I think often it's SMBs that look right. And you know, my observation would be that it's one or two companies can build a durable channel to SMBs every wave, but that's about it. And so obviously with Groupon, we believe Groupon has built a durable channel to SMBs. I think it's hard to build more than that.
Jeff?
I guess the area that I'm personally most interested in is kind of the next wave of entertainment. You know, I've done a lot of consumer entertainment, you know, type investments, but in the past. But you know, one of the things I'm involved with a company called Machinima, you know, right now, which is an entertainment network. What MTV was to videos, these are to the video game industry. And last month they served 1.1 billion views to about 130 million people, and it was all over YouTube. These are serving to 18 to 34-year-olds, and I think that they've got a really great targeted demographic that they can do a lot of things to, and that is just sitting on, I think YouTube and other platforms are going to become the world's largest MSOs, you know, out there, and that there's the analogy of building the next generations of cable channels that sit on top of those MSOs. And it's going to be YouTube, and it's going to be Xbox, and it's going to be, you know, I think eventually Facebook might do, you know, things like that. And I think there's an opportunity to kind of change how people, you know, deliver audiences to advertisers, and also deliver content on a subscription basis to users, that I think is really going to change. You know, the internet is really going to change the delivery of entertainment. So that's one area I'm really interested in. Surprisingly, I think gaming is has gone through a complete renaissance, but I'm starting to think that it's not that interesting a place to be right now, because the stakes have gotten so high, and it's going back to a hits business. And for a while there, you could kind of create really interesting titles on relatively low amounts of money, and I think that's starting to change. And to me, the risk return is not as interesting, you know, as it was.
Is Zynga a hit-driven business? I mean, Zynga tell us that they have stickiness. They're a data-driven business, and they grab their customers and keep them.
Yeah, but I think that's because they've got, you know, they do great cross promotion, you know, because they are significant scale. I think it's hard to get to that scale, and I think there's a lot more noise in the space right now. So I'm talking about like startups versus what's happening at Zynga.
Mike?
So on the areas that we like side, I'll mention one consumer one enterprise one. On the consumer side, we really like the marketplace businesses. And a simple way of saying that is that we sort of saw the first generation of marketplaces in eBay. And it was a generic one-size-fits-all kind of market. And if you sort of dissect that into many different little categories that are more specialized, we think those are amazing businesses. And marketplace businesses, especially that are two-sided markets, where people come to sell their product and people come to buy the product, and often flip sides, are just fantastic businesses. And there's in many different verticals you see these happening, whether it's vintage goods, travel, accommodations, automotive. They're all sort of different variants, but they're all great businesses. If you can get the flywheel turning on a marketplace, there's nothing quite like it. I think on the enterprise side, the stuff Anil's doing is amazing. I think, frankly, there's a dearth of companies in that. Anil's company, Workday, is fantastic, but there's many others that I think you can create, because the amount, having been an enterprise guy who used a lot of enterprise tools, some developed by our IT organization and some purchased, the inefficiency in the IT systems that are caused by premise-based applications are just vast. And by moving to the cloud, you'll see businesses truly perform significantly better through the use of those types of applications. So we think that it's still early in the cycle in that business. Categories we don't like, there's been a lot of these flash sale businesses. Don't love flash sales. Core belief, flash sales is based on a notion that people, Nike builds too many of one particular type of tennis shoes, and they have a lot of extra inventory, so that they give it to a merchant, and that merchant then markets it and sells it at a lower cost to get rid of the inventory. But if you actually believe that businesses get more efficient and they know their customers better, they're going to make the correct amount of inventory for products that they produce. And to that degree, the people who live off of excess inventory get squeezed. So we generally don't think that those are long-term particularly interesting
Is there
businesses.
an opportunity there to build? So what those businesses are trying to do is build their own branded sort of goods on top of excess inventory. Once you've established a customer base, then go out and source in China, stick your own brand on, and keep it going.
If they can turn into regular e-commerce
start something
businesses,
else.
that's great. But I don't think they can stay as flash sale businesses for a long time.
See up and down. All right, we're going to we'll take some questions. There are some microphones around. If you have any questions, let's see some hands. While we're waiting, I've got one on the late stage question and valuation. What do you think the impact of the private secondary markets has been on the sort of valuations in the companies that you're looking at? So, it seems to be, on the one hand, a tremendous thing when the IPO market is not open, that a lot of these companies do trade at some wonderful prices. On the other hand, it's pushed valuations to an incredible level, and we're now getting to the stage where we're going to see IPOs of companies at lower prices than their shares were trading at in the private markets beforehand. Zynga being presumably the first case of this. And is this a constructive development, or is it dangerous?
I think it's definitely constructive. I mean, basically, what that means is that people overestimated the value of something, and it's coming back to earth. And so, okay, they made a mistake, but that's a good lesson. So,
but there has been a sense that with a lack of transparency and a relatively thin market, that it's driven pricing up much faster than otherwise would have happened, actually to unrealistic levels.
Also asymmetric information.
Yeah.
But the seller has all the information.
I mean, are we going to see lawsuits on some of these things?
I would think so.
Look, but I wouldn't recommend that you go on second market and buy shares of Facebook tomorrow unless you have a fair bit of information about what's going on. That's not smart investing. You should invest in things that you have plenty of information about. And I think that it's caveat emptor, right? The investor should be thoughtful about how much information they have of the asset they're purchasing. It's not the seller's problem. The seller's selling a product with X amount of information. If you don't have enough information, don't buy it.
Do your funds either buy or sell on these secondary markets? Do you have any policies against that? John?
I'm not aware of ones that we've transactions we've made on those. Nope. I don't believe we have.
All right, there's a question at the back. Oh, there's one. Sorry, I can't see because of the light, but there's one just there. There we go.
Yeah. Hi. I've been really interested with this new website, Kickstarter, and I think it may be a sign of it's some type of new crowdsourcing for startups. Can you guys comment on this kind of new niche?
Kickstarter?
Anybody?
You're the media guy.
You're the Kickstarter guy.
I'm not a Kickstarter guy. Crowdsourcing for interesting ideas, particularly around the arts, is potentially pretty interesting. Crowdsourcing startups, doubtful. I don't think people always posit a lot of value on the idea, and I think that really underestimates what startups are about. Most of the value comes from the people that are in it. So, ideas are a dime a dozen. People that can execute on those ideas are rare, and that's where the real value is.
Look, I'm glad that there's more ways for people to innovate and try things. I think we live in this sort of Cambrian explosion of experiments happening in the world. And I think that a lot of the best experiments are going to bubble up and change the world. So I think the more places we can put sort of innovation capability in the hands of people who have the ideas is really good. I mean, the glib answer is that it's one thing to start a company, that's cheaper than ever. It's a whole different thing to scale a company to significant scale. I think for that, you need probably more than Kickstarter donations.
No, I'm having trouble seeing because of the light here, so one over here.
The big data and analytics opportunity both in the consumer and the enterprise space?
Yeah, I mean, I think it seems to be a very popular theme, but I think the opportunity is enormous. I mean, we've never created more information than we've created over the last few years about both in terms of on the consumer side, people posting all sorts of information and things about themselves and kind of where they are and what they're interested in, and being able to correlate all that information is a very difficult, is a big problem, and I think there's going to be a really large market there. We invested in a company called Bluefin Labs to spin out of MIT Media Labs, and what they do is they crunch an entire stream of television feeds, and then they crunch all the social media feeds, and they try to correlate, audience response to specific events on television, whether it's part of an ad or part of a speech or part of a TV show. And it's a really difficult problem, and it's a huge data ingest and categorization and semantic analysis and all that kind of thing. But the vision of what could happen, and that's just one company, and I think we're seeing a huge influx of entrepreneurs coming at the big, quote unquote, big data problem. And on the infrastructure side, you see that also with enterprises trying to do it either on their own infrastructure or on the cloud, and you're seeing technologies like Hadoop that are really amenable to help you generate and crunch large amounts of data, and I think that space is a really fruitful space.
I would say that big data now has so many people said it that the term has lost meaning. I think it's not an important term anymore. I will say that there's two categories. One is the companies that do data, like Palantir, Cloudera, others that enable it. And I think there's opportunities for a number of those companies to emerge, a few platforms. I think that on the other side, companies that don't understand how to build data and math teams, consumer or enterprise, they will all die. If you don't understand how to process the data that we all generate all the time, the companies will die.
I think recently a couple of these research shops have taken a crack at how much enterprise contained information is actually utilized for intelligent business decision making, and there's something like there's a lot of data out there, but estimates are that 70 to 80% of the data that an enterprise actually contains goes to complete waste. Just people do nothing with it. And I ran a reasonably sizable business at one point in my career, and I don't know how many times I sat there behind a spreadsheet and looked at it and said, I have no idea why UK is growing at 17% this quarter and France is growing at 2%. I just have no clue. I got more data than I know what to do with, but I cannot make heads or tails out of it. And I think the explanation for why was in the data somewhere there. But none of us could actually figure out why. And I think that, to John's point, as enterprises and consumer companies figure out to extract actual insight out of that data, solutions like big data analytics and so forth enable enterprises to do that, they'll get a competitive advantage. But today, it's still a wide open field because I don't think, I'm pretty sure that there's lots of managers, maybe some of them represented in this room, who are facing that exact problem saying, why the hell is the UK growing at 17 and France growing at 12?
Who's got a microphone? Hold up if you got the microphone. Here. Sorry, I can't see you because of the light. Yeah.
It's okay. This is a question for John, and anyone can answer. So how do you value, or how do you work at a term sheet for a company like Mozilla?
Mozilla is a nonprofit. We did probably 150 million bucks in revenue last year. We made 50 in profit. We'll do, despite the reports about Google and the search deal, we'll do significantly more next year. It's a nonprofit. There's no valuation. Mozilla's mission is to make the world better, and make the web competitive. I think that we did that on the desktop. Now the game is in mobile.
As a VC, what do you look for?
What's that?
As a VC, what do you look for in that investment? Is it a social entrepreneurship?
Well, Mozilla wasn't an investment. I was the CEO, so I was just a guy there.
He was just the guy. All right. We'll take a couple more. One. Who has the microphone?
One here. George Foster from Stanford. One of the issues you talked about was the global opportunity. And if you look at the markets such as China, India, Russia, they're very complex markets to sort of get your head around in terms of enforcement of contracts or struggling with joint ventures. How do you assess that in terms of valuations?
So I'll answer it two ways. For relatively early stage companies that are US or European based, generally speaking, those are tough markets to reach, period. And so aside from how you assess that in terms of valuation, we typically don't recommend for our early stage startups to really go after those market segments unless they have a mousetrap that's specifically designed for that, or whatever the case may be. They're, as you correctly point out, they're tough markets. As companies get to kind of a more evolved state, you have to bring in, or you have to think through what your strategy is in each geography and whether it's realistic for you to win or not in that market. China in some cases is just not a reachable market for US internet-based companies. Brazil can be. Russia depends, right? And so I think that you have to be pretty thoughtful, rather than just sort of saying global's great, all these big markets, lots of people coming into the middle class, I think you have to be very, very thoughtful about each one of those markets and whether they are realistically a target market for you or not. And when you go after them, what methodology do you use to go after those markets? And how effectively could you potentially monetize them? In other words, you could penetrate them, but they may never monetize for you. And you have to do it on a case-by-case basis, depending on your product and your sector.
For us, the two of the geographies you were discussing, China and Russia, we have an office in China, and one of the core themes that you look at, when you're investing in China is investing with the government tailwind. In other words, you kind of go after things that that the government will want to promote, and you avoid things where the government could put the company out of business with a stroke of a pen. So as an example, being on the edge on content, the government can wipe you out, basically overnight, and they have done that, to several industries. With regard to intellectual property and privacy, I think it's just one of the things that you factor into in terms of which businesses you're going to invest in. And so I think it's more not, do you factor it into the valuation? It's either a 0 or a 1. Is it an interesting space, or do you just want to stay away from it because of regulatory, potential regulatory issues or potential copyright or piracy issues? With regard to Russia, we spent a bunch of time looking at it, and our conclusion was that we couldn't handicap some of the sovereign risk issues there, and so we've chosen, we continue to look at investments, but our bar is really high, and it would be really hard for us to I think, justify doing that, because we'd have, our base of knowledge would have to be so high to get comfortable with the risks, and I think it's unlikely we'll do it.
All right, let's take two more quick ones, and then we're going to break. One over here.
Hi, my name is Abhay, and the question is for Jeff. You talked about entertainment and video. Can you talk a little bit about second screen technologies, and also wanted to ask you about overlay CDNs. Where do you see?
And what?
Overlay content delivery networks. Yeah,
well, I I've been very interested in new entertainment technologies and consumer experiences because I think the technology is there for a great unified consumer experiences where you combine the best of broadcast and best of broadband in a terrific consumer search and navigation experience, and I think that experience should live in the cloud, and you should be able to do it from any TV that you want to, and you should be able to see any content, and you should be able to manage subscriptions and all that kind of stuff. The problem is not a technology one, though. I think it's really one of rights issues, and it's one of your service provider and what they're willing to, or not willing to allow kind of come over the top and different levels of integration. And so I'm still really interested in that because I think you could build a great consumer experience, but every turn I get daunted by non-technical issues and ones surrounding protectionism and content rights. So I don't know if that answers your question, but.
And any more? Should we call it a day there? I can't see any hands. All right, we'll take that one and then we'll break for coffee.
Thank you. I'm James Marr. John, you had mentioned that you had an interest in education. I think that's been perceived as having a very long sales cycle, rigidly entrenched interest, and somewhat of a difficult market. Could you elaborate on where you're seeing opportunities? Is it content management, instruction, learning management systems? And gentlemen, more broadly, how do you think about investing in segments of that kind where you see more difficult structural aspects of the market?
Yeah, well, so I should say, I guess it's coming into the industry, everybody says, apparently every new investor comes in and says, man, education's all broken, total investment area, this is going to be awesome. And everybody says, yeah, we've heard that before. That happened 5 years ago and 10 years ago, and everybody always thinks education's ripe. But the observation I would make, though, is that we think about education, I think at levels, so I think about K-12, mostly domestic here, but I'm talking about K-12 and then university. We think about it inside the system and outside the system. I think my point of view on K-12 is that it's a terrible, terrible place to invest inside the system, but there's lots of opportunities outside the system to disrupt from the outside around parent-directed spend and things like that. University and higher ed, I think it's just one of these last industries that hasn't been disintermediated, that hasn't been direct to consumer. Like one of the big costs of universities, not Stanford so much, but a number of universities, is marketing costs. And there's no reason why you can't drive that closer to zero, like customer acquisition in other industries. So as you drive that to zero, suddenly everything becomes more accessible for a much lower price. You start to open up accredited degrees around the world. So I haven't made any investments there. I think that the way we interact, the way we think about accreditation, or the way we think about job training, all that stuff is ripe for disruption. So I'm looking for that. I think the university system in probably 15 years is likely not to look too much like we have today.
Right, on that, we'll break. Gentlemen, thank you very much indeed. And we'll see you back here in 15 minutes.